All right, welcome back. Invest Info, episode 40. And today we're going to be talking about stock options and selling covered calls on a stock that I am bullish, which is Alibaba. And first of all, I want to, just say a disclaimer that I'm not a financial advisor. These are tips, but you have the right to invest in whatever you like to invest in. I'm just putting out information that I hope can be helpful to those that are, trying to navigate through the stock market. So let's begin. All right. So options, right? If you've heard about options, a lot of people don't really understand options. They kind of see it as a way to double their money quickly. A lot of people gamble, so the stigma that's associated with options is they're risky. Um, However, what if I told you that options were created to help protect crop growers? That's what they were created for because um, well, let's get into it and then you'll see what I mean. Okay, what are options? This is according to Google. An option, all right, stock options, also commonly referred to simply as options, are different. When you invest in stock options, you essentially purchase the right to buy or sell shares of an underlying stock for a set price at a future date. Now let's go back to those the crops, right? Let's say you don't know what sort of harvest you're gonna have as a farmer. You don't know if a hurricane might come through. You don't know what different factors could happen in the future. But you wanted to sell your stock at a certain price. Um, but those effects, whether it be a hurricane, could affect the price of the crops that you are ready to harvest and sell. Right? It could bring it up in price. There could be a shortage, and it could increase the price. You don't really know in the future. But let's say you say, you know what, I'm fine with selling my crops at this price next year, no matter what. Just as a contingency, something was to go bad. That's when you and the buyer, let's say you want to agree at selling your certain crops at $15. So you're going to say, look, a year from now, I'll sell you these uh, crops at $15 per every pound or whatever. Just an example. No matter what happens in the future, a hurricane, or we have a surplus, or we have a shortage, just as a set price. And there's a premium for that. Okay, meaning there's a cost to sell this, come to this agreement. And the same thing happens in the stock market. When you sell an option or buy an option, there's always a buyer and a seller when it comes to the options. And we are in the business of selling options, not just us, but guys like Phil Town, guys like Warren Buffett. They sell options because when you buy an option, all right, it's an depreciating asset in time. All options will eventually expire. Some could expire with value, but 80% of the time, they expire worthless. That would benefit the seller of the option. So we're in the business of selling these options, and there's ways to do it to make passive income. In fact, if you could jump back to episode 14, I show you how to do it on a weekly basis. And at the end of the video, I'm going to clip it at the end where I cover and sell positions in Alibaba, right? Um, so when you have an option, it says when you buy an option, there's no direct ownership of the company at all. Exactly. You're buying the rights to purchase shares in the future. You don't own the shares. That's how come an option would be cheaper than actually buying 100 shares of a stock, because that's how options, that's the share amount that these that are required for selling the rights or owning the rights at that set date. It's 100 shares. If you're gonna sell um, options, okay, you have the ability to sell naked, which means you don't own the rights to the shares, or you could sell covered, which means you own the rights to the shares and you're willing to let them go at a set price. And that's the options we deal with. We sell covered calls. If you sell naked or borrow the shares from your broker, there's an infinite loss potential there. So we rather have our calls covered, okay? Because in essence, let's say this, right? Let's use Alibaba as an example. Today, the stock is trading at 179, 180. Let's say your average in Alibaba is $100 or $150 rather, right? You could sell it now at 180. But you said, you know what? I'm I'm completely fine with getting out Alibaba at $220, right? You could sell your rights away to Alibaba next year. Say, look, no matter what the price of Alibaba is, I'm giving you I will sell it for 220. So if Alibaba is above 220, let's say 235, 250, you're selling your rights away to sell it at $220, and you collect the premium. And the premium uh, it's your cash. You could use it right now. You could go ahead and reinvest it. What Warren Buffett and Phil Town typically do, they sell these options, use a premium. I'm talking about contracts that are sometimes 3, 5 years out, and they then reinvest the premium they collected. So what's a call option? A call option. This is from Investopedia. I'm sorry. What is a call option? Call options are financial contracts that give the options buyer the right, but not the obligation, to buy a stock, bond, commodity, or the asset or instrument at a specific price within a specific time period. The stock, bond, or commodity is called the underlying asset. A call buyer profits when the underlying asset increases in price, right? Because let's say you agree to buy something at, let's say you agree to buy a pair of sneakers for $50 next week, okay, and you guys set that contract, and for some reason, I don't know, Kanye's wearing the sneakers and the value of the sneakers doubled in price. So now they're worth $200, but you agreed with that person that you buy for $100. So now you're paying $100 for something that's worth $200. So that would benefit the buyer. Um, it says now, again, let's say that agreement, you pay $10 to do that agreement. Now, if you were selling those sneakers, you just made $110 on the sneakers instead of making the $200 on the sneakers, right? So you missed out on certain profits, but you did lock in $10 guaranteed and the sale of those sneakers at that set price. So that's sort of what we're doing with these options here. So yeah, we're just dealing with the stock options, and it says the purpose of a call option. Call options are often used for three primary purposes: income generation, speculation, and tax management. Right? Because options are they're way more volatile than the underlying asset or the stock. So for instance, a stock could jump 5%, but the options could jump 50% based on that 5% move. And that's sort of why people buy them today. Most people buy them for that volatility purpose or to gamble, but we're telling you don't buy it for that purpose. Okay? We're more about getting the premiums and reinvesting the premium and using the premium for whatever purposes we want to do. Okay? Because 80% of options expire worthless, so it behooves you to not be a buyer of these options, not to gamble, because rule one, Phil Town says what? Not to lose money. Warren Buffett also says the number one rule in investing is not to lose money, and the number two rule is not to forget rule one. So we're in the business of not trying to lose money. Okay? Now I mentioned that we're going to do covered calls, right? Now this is Investopedia again on covered call. Professional market players write covered calls to boost investment incomes. So a covered call is when you own the underlying asset. You own 100 shares of the stock. A naked call is you don't outright own the 100 shares, but you're borrowing it from the broker. And we don't want to borrow it. We want to own these shares. All right. So whatever stock you're looking at, whatever company you're bullish in, or you plan to hold for the next couple of years, if you have 100 shares and you're at a very low cost basis, a low average cost, and you say, you know what, I'm willing to let this go at 50%, no matter what happens, you could sell that contract. You could sell that right to that contract, and there's a fee for it. And you could use that fee to do whatever you want. But individual investors can also benefit from the conservative but effective option strategy by taking the time to learn how it works and when to use it. In this regard, let's look at the covered call and examine ways it can lower portfolio risk and improve investment returns. It says a covered call is a popular option strategy used to generate income from investors who think stock prices are likely to rise much further in the near future. A covered call is constructed by holding a long position in a stock and then selling the right and then selling, writing call options on the same asset representing the same size as the underlying long position. That's sort of confusing. It's not really confusing, but the way they worded it could be confusing to a new investor. Basically, it's saying what I was just previously saying, which is we could profit from the premium um, that we make when we write these contracts. Even if you so if you're long term this stock and you're just willing to say, you know what, I'm gonna come back into it a year and I'm willing to let it go at a price at this price within a year. That's what you're doing when you're selling the call option. You could do it weekly, depending on the underlying asset. Some certain stocks do offer weekly options trading, monthly options trading. Heck, the S&P 500 offers 2-day options trading. So, but you would have to, again, whatever stock you wish to sell a position and write a contract for, you have to own 100 shares of this stock, and make sure that the stock has the ability to trade options, because not every stock has the ability to trade options. Okay, so a covered call or entitled to several rights as a stock or futures contract owner, including the rights to sell this security at any time for the market price. Covered call writing sells this right to someone else in exchange for cash, meaning the buyer of the option gets the right to own your security on or before the expiration date at a predetermined price called the strike price. Right. So that's another thing too. You, so let's say let's say you sell an option. Let's say you're in a stock that's worth $10 and you sell an option for $20 in the next, I don't know, 6 months, right? You say, I'm willing to let go of this stock at 100% return if it goes up 100% in 6 months. Let's say that same position you open, for some reason that stock rockets up to $30. They have the right to exercise or buy your shares from you at $20 before the expiration date, before the 6 months. As long as it's above $20, all right, the set agreed strike price, they have the right to now what? To your shares. You could buy back your shares, but it's going to cost you more money. Or you could say, you know what, I don't care if it's $30. I'm fine with letting it go at $20. So what the professionals do, like Phil Town and Warren Buffett, these guys, they'll value a company and say, you know what, what's the true value of this company? And if they think the company is overvalued, they're willing to let it go at an overvalued price. When they feel the stock is overvalued, they're willing to let it go. No matter what it's doing, eventually they say, look, it's going to come back down to its true intrinsic value. And right now it's overvalued, so we let it go at this overvalued price. It says the call option is a contract that gives the buyer the legal right, but not the obligation to buy 100 shares of the underlying stock or one futures contract at the strike price anytime or on or before the expiration. If the seller of the call option also owns the underlying security, the option is considered covered. Exactly. So if you own the right to these stocks, it's considered covered. That's what we do. We sell covered calls because they can deliver the instrument without purchasing it on the open market at a possible on the open market at possibly unfavorable prices. So I own over 100 shares of Alibaba. My average is 167. The stock is now $180. I sold a call option for 3 years out, 2024, and the premium for that was $3,000. However, the stock has ran up way past that 160. Now to buy back the stock will be $5,000, right? So the fact it went up is now $2,000 extra to purchase the rights back. So you have the option to say, look, I don't want to pay that $2,000. I'm willing to let go of Alibaba at 180. Myself, however, I'm willing to stay in Alibaba. I think it still could continue. So I'm going to cover that 180 strike price, right? Because remember, my average is 167. I'm still in lower than 180. And then I'm going to resell a call option at a higher strike price, somewhere in the 220s. So I'm slowly using the premiums to invest elsewhere, watching it slowly go up. And if I wish to continue to stay in the stock, I'll buy back my rights, and I could either sell it at a higher um, strike price, or I could just get out the stock entirely, or I could just not do anything. So I'm gonna cut this video to where that's what I do at the end, and I'll show you guys how that works at the end. All right, so that's pretty much selling covered calls. You could always paper trade this approach to get an idea of it, not using real money, and because this, if you don't understand what you're doing, um, and stock goes the opposite direction, you could not really, kind of get confused and think you have to buy this back or think you're losing money. When really the best thing to do when you sell covered calls and the stock goes up is to just wait. Not really do much of anything. So, and that's really the one of the key things people um, sort of mess up when it comes to investing in the stock market is activity. So, all right, so the clip is at the end, and I hope this was helpful. All right, guys, so I'm at Alibaba. All right, I'm currently up 8% total return on Alibaba. My average is 167, so I'm gonna go ahead and close this call option here, okay, because you see I sold a 180 call. Alibaba is now above my current strike price. I sold it for 30,000. It's now worth 5,000, so I have to buy it back. So I'm gonna hit buy. I'm gonna buy one, and I'm gonna put a bid at let's say 4,900, and let's see if someone is willing to sell it to me for that premium. Okay, it's sold. I have my rights back to Alibaba. Now what I'm gonna do is I'm gonna go back to 3 years out, and I'm gonna sell a call now at $230. Short, sell one, 3,000, and let's see if we have a buyer. Do we have a buyer? The order's been placed. So what this is now saying is I'm willing to sell 100 shares of Alibaba for $230. I'm willing to let it go for $230 a share, and the premium for that is $3,000. And if this order goes through, that $3,000 premium, you could do whatever you want with it. You could take the cash out now. You could go ahead and reinvest it. But the reason the premium was so high is because I sold it 3 years out. So